Inflation salvation. Hey, this is Dave with the Bolduc Realty Group, brokered by eXp. Welcome to my weekly real estate market update. Today's July 21st. We're going to talk a little bit about what's going on with inflation, where I think things are headed. Before we do that, I want to talk about some key Connecticut market stats. First off, active on the market, 4,157 homes. That's up from the 4,043 homes we had last week. It's 114 difference. So that's we're seeing some improvement in inventory. This is good for buyers. There were about 312 new listings over the last 24 hours. Typically, we see Fridays have the biggest number of new listings going into the weekend, and we've seen 300-400 before. The fact that we're seeing the overall number go up and 300-400 is kind of a normal number for Friday means we're seeing listings outside of Friday as well. So hopefully that's an indication that the market is starting to get stronger. More sellers are coming into the market because prices are so high, and we're seeing some benefit from that, especially on the buyer side where you're having a little bit more selection and maybe just a little bit less competition. We had 4,064 closings in June. That's up almost 1,000 from the number of closings in May. But because there's 4,064 closings in June and we have 4,157 active houses, we still have about a month of inventory on the shelf. So it's still a strong seller's market today. Some key dates here, and I really wanted to jump into one thing that came out this month. Job and inflation reports were all favorable. The job creation was about 13% less than what the forecast had. So that means the economy's not quite as hot as expected. And that means that demand is potentially coming down, which will drive inflation down if that's the case. So that's a good thing. CPI came in at about 3% in June. In May, it was over 4%. And it was a peak of 9%. So we are definitely seeing the inflation from a CPI perspective come down. PPI came in at plus 2.6% in June. And it's been going down. PPI has been going down for several months. It has been very low. PPI is producer price index and CPI is consumer price index. What we're starting to see, and hopefully this continues, is that savings that we're seeing on the producer side is starting to bleed over into the consumer side. And that's when it's going to start hitting your wallet favorably when you go out to shop and things like that. The Fed targets the personal consumption expenditure index, which is yet another measure of inflation, and they like to see about 2%. In May, it was 3.8%. Unfortunately, the Fed is going to meet this month, next week, before the June PCE report comes out. So what does that mean? I think that alone means that the Fed is going to raise interest rates another 1/4 point. And this is what pretty much everyone thinks. So it's not some brilliant analysis on my part. But we are going to see another 1/4 point raise on the Fed funds rate. The mortgage rate should take that in stride because the market already expects it. What we have to do after that Fed meeting is wait until September 19th and 20th for the next Fed meeting. There's no meeting in August. The good news on that is we're going to have 2 full sets of reports. We're going to have 2 CPI reports, 2 PPI reports, 2 job reports, 2 personal consumption expenditure reports. All of that information will be available for the Fed to assess and hopefully be able to declare, okay, hey, we're making some progress here. Hopefully the trends keep going. Talking about the primary mortgage market survey, interest rates eased. The average interest rates eased a little bit from last week. They had spiked over 7% the last few weeks. The favorable jobs and inflation data reports, I'm sure, had something to do with that. In the long run, interest rates have stayed relatively constant in that high 6%, maybe low 7% range over the last several months. It seems the market is waiting for the Fed to finally declare inflation is defeated. The sooner the better, in my opinion. Keep in mind, though, if you bought recently or you're buying now in a home, mortgage rates will go back down. Just Google historical mortgage rates in the U.S., and you'll see the chart goes like this all over the place. So we're at a peak right now, hopefully, and we're going to see it come down over time. When that happens, you refinance and you're able to capture that savings. So keep that in mind as you move forward and look at the affordability of homes. Anyway, that's all I've got for today. If you have any questions, comments, throw them down below. Please like, subscribe, ring notification bell. I hope you guys have a great Friday and a great weekend. We'll talk soon.